On a spring day in 1832, no institution in the United States wielded more financial power than the Second Bank of the United States. From its Parthenon-style headquarters on Chestnut Street in Philadelphia, the bank controlled the nation's currency, regulated state banks across the country, and held the federal government's money in its vaults. Its president, Nicholas Biddle, was arguably the most powerful financial figure in America. Foreign investors held stakes in the bank. Wealthy merchants and industrialists relied on it, and Congress had chartered it. To most of the nation's elite, it was indispensable. Yet President Andrew Jackson saw something entirely different. He saw a monster, a corrupt institution designed to enrich the privileged few at the expense of ordinary farmers, mechanics, and laborers. And he was willing to destroy it, consequences be damned. What followed was one of the most visceral political conflicts in American history. It wasn't fought with weapons, but it was every bit as brutal. The Bank War, as it came to be known, would reshape the American presidency, tear the nation's economy apart, and fundamentally alter the balance of power between the executive branch and financial institutions. In his July 1832 veto message of the bill rechartering the Second Bank of the United States, President Andrew Jackson triggered the demise of America's second central bank with a stroke of his veto pen. But to understand this war, we need to go back further. We need to understand why Jackson despised banks in the first place, and how America ended up with a central bank that one man decided to demolish. On a personal level, Jackson brought with him to Washington a strong distrust of banks in general, stemming, at least in part, from a land deal that had gone sour more than 2 decades earlier. In his younger years, Jackson had engaged in land speculation, a common venture for men seeking to build wealth in the early American Republic. He accepted payment in the form of paper notes, essentially paper money issued by banks. When the banks that had issued those notes went bankrupt, the paper Jackson held became worthless. He never forgot that loss. Jackson's distrust of the bank was also political, based on a belief that a federal institution such as the bank trampled on states' rights. In addition, he felt that the bank put too much power in the hands of too few private citizens, power that could be used to the detriment of the government. For Jackson, there was only one acceptable form of money: hard currency, gold, and silver coins. Everything else was suspect. Jackson wasn't entirely alone in these sentiments. The nation had already experimented with a central bank once before. When Alexander Hamilton called for a Bank of the United States in his report on a national bank, he envisioned a central bank that would sustain a developing national economy. Congress chartered the first Bank of the United States in 1791, and it operated for 20 years until its charter expired in 1811. Many opposed it, viewing it as a tool of the wealthy. When Congress didn't renew its charter, the bank quietly disappeared. But then came the War of 1812. The next year's War of 1812 bankrupted the U.S. Treasury, and the same state banks that opponents of the bank had claimed were perfectly capable of managing American finance turned out to be incredibly unreliable. The government couldn't pay its soldiers or its debts. Something had to change. After several years of debate and formulation, the United States Congress authorized the Second Bank of the United States as a public-private enterprise in 1816 for a period of 20 years. The new bank was larger and more powerful than the first. It handled federal deposits, issued paper currency, and was supposed to bring stability to American finance. Instead, it catastrophically mismanaged its responsibilities. Only a few years after its opening, the United States experienced its first peacetime economic crash, the Panic of 1819. The bank responded to the crisis in ways that seemed only to make the Depression worse, reigniting public resentment against it. The bank's early leadership had made reckless loans to insiders and friends, many of which never got repaid. When a new president, Langdon Chavez, took over, he reduced the bank's liabilities by more than one-half, lessening the value of banknotes, and more than tripling the bank's specie held in reserve. At the same time, the prices of American goods abroad collapsed. This led to the failure of state banks and the collapse of businesses, turning what could have been a brief recession into a prolonged depression. The anger was immense. One financial writer captured the sentiment perfectly. The bank was saved and the people were ruined. By the time Andrew Jackson entered the presidency in 1829, Jackson's disaffection with the powerful central bank and its paper money could be traced as far back as the first bank of the U.S. Jackson lost everything during the time when the market expansion and the availability of Western lands should have offered safe opportunities for economic improvement. He was ready for a reckoning. On the opposite side of this conflict stood Nicholas Biddle, a man who in many ways was the very personification of everything Jackson despised. From the moment Biddle took the helm of the second bank in 1823, he transformed it into something it had never been before, the first truly effective central bank in American history. Biddle was brilliant and precocious. He had graduated from Princeton at age 15 and subsequently served President James Monroe as a secretary. He was also an accomplished author and editor. Unlike the rough-hewn Jackson, Biddle embodied the Eastern establishment: Philadelphia high society, classical education, refined manners, and absolute confidence in his own judgment. Under Biddle's firm direction, the second bank grew into a powerful instrument of monetary stability, the rock upon which a decade of robust economic growth was built. From 1823 onward, Biddle ran the bank with skill and innovation. He pioneered techniques of central banking. He controlled the money supply and interest rates. He made sure state banks didn't lend recklessly. For roughly a decade, it worked. The economy grew. Currency became more stable. Business flourished. But Biddle had a fatal flaw. For all his financial brilliance and managerial skill, Biddle had faults that proved to be fatal for the bank and his career. Arrogant, hypersensitive to criticism, and unschooled in politics, he failed when put to the test during the vitriolic battle between Biddle and President Andrew Jackson over the rechartering of the bank. The bank war was a political struggle that developed over the issue of rechartering the Second Bank of the United States, BUS, during the presidency of Andrew Jackson, 1829 to 1837. This resulted in the shutdown of the bank and its replacement by state banks. The bank's charter was set to expire in 1836. In theory, there was plenty of time. But time, it turned out, was a weapon. Jackson's political opponents, led by Senator Henry Clay of Kentucky, hatched a strategy. Clay was planning to run for president in 1832, and he believed the bank could be a winning issue. This forced Biddle into a difficult position. Clay and his allies were the only powerful supporters the bank had left. If Biddle rejected their advice and delayed the recharter, he risked losing the only support he had left in Congress. Biddle faced a choice. Wait until after the election, when Jackson's political power might be weakened, or push for recharter immediately and hope that Congress would have such overwhelming support that Jackson wouldn't dare veto it. Biddle chose wrong. Biddle submitted his bid to recharter the Bank of the United States to Congress on January 6, 1832, with concessions he hoped would placate the president and his supporters. Congress passed the recharter bill by comfortable margins. Biddle believed his own press. He believed that the bank was too important to destroy, that Jackson wouldn't risk the political backlash of vetoing it. He had catastrophically underestimated his opponent. In his July 1832 veto message of the bill rechartering the Second Bank of the United States, President Andrew Jackson didn't hold back. Beyond characterizing the bank as hopelessly corrupt, he argued, the powers conferred upon the bank were not only unnecessary, but dangerous to the government and the country. Jackson's veto message was unlike anything American politics had seen before. In all the presidential messages, inaugurals, annuals, vetoes that came before, there is nothing like this. Other presidents had sometimes warned Americans of foreign perils or the dangers of factionalism and divisiveness among equally well-disposed and meritorious citizens. Andrew Jackson warned them against their government and each other. Jackson framed the bank not as an economic question but as a moral one. He spoke directly to working people, to farmers and mechanics and laborers, and told them that the bank existed to make the rich richer and the powerful more powerful. Jackson's frank branding of Americans by occupation and circumstance, his bold counterposing of rich and poor, and his solicitude for the working farmers, mechanics, and laborers against the rich and powerful seemed to many then and later a promulgation of class warfare. The veto stunned Philadelphia. It stunned Congress. Biddle had assured everyone it wouldn't happen. One contemporary reported Jackson saying about Biddle, "The bank is trying to kill me, but I will kill it." Jackson was true to his word. Jackson ran under the banner of Jackson and Reform, promising a return to Jeffersonian principles of limited government and an end to the centralizing policies of Adams. The veto became the central issue of the 1832 presidential campaign. Henry Clay, Jackson's opponent, believed that the bank was popular enough that Jackson's veto would cost him the election. He was catastrophically wrong. Jackson won re-election in a landslide. To Jackson, this wasn't just a victory. It was a mandate. The people had spoken. They agreed with him that the bank was a corrupt monster that needed to be destroyed. Jackson's veto of the bank charter and the removal of the federal deposits to the state banks worsened the panic of 1837. But in 1833, standing fresh off his electoral triumph, Jackson didn't think about what might come later. He was focused on one thing, finishing what he'd started. On September 22, 1833, Jackson removed his Secretary of the Treasury, William Duane, because Duane refused to pull federal deposits out of the bank. Jackson replaced him with Roger Taney, a man who would obey his orders without hesitation. In late 1833, now Treasury Secretary Taney ordered that the government's deposits be removed from the bank, hampering its ability to carry out what the court had found to be acceptable and even crucial bank activity. The order was swift and devastating. Federal money that had flowed into the Bank of the United States for years was suddenly rerouted into a network of state banks, which Jackson's critics mockingly called pet banks. Biddle retaliated. Fearing economic reprisals from Jackson, the bank president made a calculated decision to fight back using the only weapon he had, credit. Biddle's actions created a minor panic. According to Carpenter and Schneer, Biddle's plan massively backfired, generating resentment in the business community and all but proving President Jackson's point that the powers of finance were not to be entrusted to a single incorporated institution. Biddle raised interest rates. He restricted lending. He was trying to create enough economic pain that businesses would demand Jackson reverse course and return the deposits to the bank. It was a game of financial chicken, and Biddle was betting that the pain would force Jackson's hand. It didn't work. Jackson didn't flinch, and the public, rather than blaming Jackson, blamed Biddle for the economic hardship. The bank's president had just proved Jackson's entire argument. A single man, controlling a single institution, could wield devastating power over the nation's economy, and he could use that power for personal political reasons. The removal of the deposits sparked the emergence of a new political party. Jackson's enemies, who had been scattered and disorganized, coalesced around opposition to what they saw as his tyrannical use of executive power. Whigs championed an active federal government committed to internal improvements, including a national bank. They made their first national appearance in the presidential election of 1836. They borrowed their name from an 18th century British political party that had opposed the power of King George III. In the eyes of the Whigs, Andrew Jackson had become King Andrew I. Whigs opposed what they viewed as the tyrannical rule of Andrew Jackson. For this reason, they named themselves after the 18th century British-American Whigs who stood in opposition to King George. Political cartoons depicted Jackson standing on a shredded constitution, holding a scepter and a veto like instruments of despotism. The Whigs even attempted to formally censure Jackson in the Senate for what they considered an abuse of presidential power. But censure was symbolic. Jackson had won. More damaging was the removal of federal deposits in 1833, resulting not only in a reduction in the bank's size, but also in its ability to influence the nation's currency and credit. In April 1834, the House of Representatives voted against rechartering the bank and confirmed that federal deposits should remain in state banks. The bank's death was assured. Its charter would expire in 1836. It would be more than 75 years before the United States made another attempt to establish a central bank. Jackson had won his war. The central bank was destroyed. But victory came at a terrible price. For Biddle, the destruction was personal as well as institutional. The federal charter expired in 1836, before the Panic of 1837, but the bank continued to operate with a Pennsylvania state charter until its ultimate collapse in 1841. As a state bank, the second bank was no longer constrained by federal regulation. Biddle, desperate to recover the bank's losses and repair its reputation, made increasingly reckless decisions. As president of the Pennsylvania Bank, Biddle authorized risky loans and investments and hatched a dubious plan to use bank funds to corner the market on cotton. It all went catastrophically wrong. The bank collapsed in 1841, taking Biddle's personal fortune with it. The collapse of the bank consumed Biddle's personal fortune and what remained of his reputation. Broke and shunned by old friends and associates, he retreated to his wife's estate, where he died at the age of 58, heartbroken, according to his biographer, at the loss of the bank and his fall from grace. When Biddle died in 1844, he was viewed as a cautionary tale, a brilliant man destroyed by his arrogance and his inability to navigate the political terrain. But Biddle wasn't the only casualty. The American economy also paid a price. Without a central bank to regulate the money supply, American finance descended into chaos. Hundreds of state banks, many poorly managed and undercapitalized, issued their own paper currency. Merchants faced a bewildering welter of paper money with no standard value. In the absence of any regulatory authority, speculation ran rampant. In July 1832, President Jackson vetoed the bill to recharter the Second Bank of the United States, the nation's central bank and fiscal agent. As the bank wound up its operations in the next 4 years, state-chartered banks in the West and the South relaxed their lending standards by maintaining unsafe reserve ratios. Jackson's other policies made matters worse. The Specie Circular of 1836 mandated that Western lands could be purchased only with gold and silver coin instead of bank loans. This was designed to cool the real estate bubble, but it drained gold and silver from the banking system at precisely the wrong moment. Unfortunately, this policy proved a disaster when the Bank of England, the source of much of the hard currency borrowed by American businesses, dramatically cut back on loans to the United States. Without the flow of hard currency from England, American depositors drained the gold and silver from their own domestic banks, making hard currency scarce. The result was catastrophic. The Panic of 1837 was a financial crisis in the United States that began a major depression that lasted until the mid-1840s. Profits, prices, and wages dropped. Westward expansion was stalled. Unemployment rose and pessimism abounded. The economy collapsed just 4 years after Jackson's veto. Many individual states defaulted on their bonds, which angered British creditors. The United States briefly withdrew from international money markets. Only in the late 1840s did Americans re-enter those markets. The Depression lasted nearly 7 years. When the U.S. suffered a banking panic in 1837, the economy slipped into a severe depression that lasted until 1844. Businesses failed. Banks collapsed. Unemployment soared. Working people, the very farmers and mechanics that Jackson claimed to champion, suffered terribly. Private citizens created copper tokens called hard times tokens that mocked Jackson and the banking chaos. Some depicted the president as responsible for the economic catastrophe. Jackson's hand-picked successor, Martin Van Buren, was elected president in 1836. He inherited the economic wreckage and bore the political blame. Van Buren refused to use the federal government to intervene in the crisis, believing it would set a dangerous precedent. This refusal to act during an economic emergency contributed to the Whigs' political resurgence. Jackson had destroyed the central bank in the name of defending common people against a corrupt elite. But the result was not a more equitable financial system. It was chaos and suffering for ordinary Americans. The bank war cost Philadelphia and the nation a central bank, shifting the nation's financial center to New York City. Thereafter, local banks lacked any regulating authority, and the resulting speculation triggered panics throughout the rest of the century. The United States would operate without a central bank for more than 75 years. During that period, the nation experienced multiple banking crises and devastating panics. The economy was volatile. Financial crises occurred with alarming frequency. However, after the Panic of 1907, which triggered a nationwide suspension of payments and a deep recession, Congress established a commission to investigate ways to improve the banking system's response to shocks. This commission eventually led to the creation of the Federal Reserve in 1913. The new institution created by the Federal Reserve Act struck a balance between public and private, centralized and local control of the monetary system. A Federal Reserve Board in Washington would oversee operations carried out by not less than 8 nor more than 12 district banks spread around the country, under the direction of representatives from local banks. The Fed was explicitly designed to avoid the mistakes of both the Second Bank of the United States and the chaotic era that followed its destruction. It would be more decentralized than Biddle's bank, reducing the concentration of financial power in any one institution. But it would also be stronger and more technically sophisticated than state banks, providing the national economy with the regulatory oversight that Jackson had so violently rejected. Andrew Jackson saw himself as a champion of the common people, fighting against an aristocratic elite that used government power for selfish purposes. In many ways, he was right. Supporters claimed that the bank helped regulate prices, extend credit, provide a reliable currency, and offer essential services to the Treasury. However, Jacksonian Democrats and other opponents highlighted troubling examples of favoritism, alleging that the bank catered to wealthy merchants and speculators while sidelining farmers, artisans, and small businesses. The Second Bank, under Biddle, was a powerful and somewhat unaccountable institution. It did favor certain interests. It did wield enormous influence. Jackson's concerns about concentrated financial power were not baseless. But by destroying the bank in his effort to decentralize power, Jackson created something perhaps worse, a system with no central authority to prevent financial chaos and speculation. Although The aggressive means by which the bank was dismantled led to a system-wide financial failure and recession in the short term. The long-run outcome was likely a wider diffusion of banking services and a more efficient allocation of capital. Some historians argue that eventually, after the suffering of the panic years, the economy benefited from the breakdown of centralized banking power. Others argue that the human cost of those panics, the unemployment, the business failures, the shattered lives, was too high a price to pay for a theoretical long-term benefit. And they point out that Jackson's populist rhetoric, while emotionally powerful, didn't actually solve the problem of concentrated wealth and power. It just moved it from Philadelphia to New York's Wall Street, where it soon flourished under different auspices. In a lengthy battle over a national banking system, President Andrew Jackson reshaped the American economy to run without a central bank until the Federal Reserve was created in 1913. He strengthened the executive branch's role in ways that reverberate today, demonstrating the president can take a strong role in national affairs.